Awesome. All right. Now that we're recording, let me go ahead and introduce ourselves. Hey, good afternoon, everyone. This is an options one-on-one class. We're going to be talking about calls and puts and vertical spreads. This is a continuation of what we started on Saturday, uh, just to clear up some things, some concepts that are still missing for beginners. This is actually designed for people who are new to options, who've traded very lightly. Maybe you've traded one or two contracts. You're still buying calls or buying puts. So we'll just brush over the concepts that we went over on Saturday. And we're going to introduce a few more concepts. Basically, we're going to finish up what options 101 is. At the end of this session, you will be able to fully understand what a call contract is, a put contract is, and what a vertical spread is. You will also see a live demonstration of how to enter this trade. We're going to be using two tools today. The first one is thinkorswim, which is what you're looking at right now. I am in the simulated trading version, which is as close as you can get to real time. Only that it's paper money. It is the equivalent of the TradeStation sim, just a little bit more reliable. I am also going to be using the sim trading on TradeStation. And the reason I will use it is because, not that because it's so great, but because that's what a lot of people are using. And so it's worthy of mention. So welcome everyone. Does anyone have any questions before we begin? And can everyone hear me, by the way?
Yes.
Clear.
Awesome, awesome, awesome. All right, good deal. Just before we got started, we had a little game going on. We were talking about SPX, which is the S&P 500 index, and we were discussing or trying to figure out where is it going to close today, 0DT. Today is Friday, so it's expiring today. And the game is based on your charting, based on what you know about the SPX. Even though we're not going to spend a lot of time on it, just put in the chat what you think it's going to close at, right? Just a number, just no explanation needed, just a number for now. So that's the game that's going on right now. And then to get us started here, we're going to talk about a couple of stocks. I had people say Netflix, right? So the Netflix symbol is an FLX. See what Netflix is doing. It looks like Netflix right now is in, it's trying to play this gap. Let's go to the daily gap here. Go to the 6 months, 1 day. Looks like we have some action that's going to try and close this gap right here. So it's a nice $40, $50 gap right now. We're inside it. We've tried to close it before a few times. Today we are actually it's still going. Current price is at 513. And we're going to try and see what happens by the end of the day. Okay. And then also let's add to our game today. What do you think Netflix is going to close at today? Right? What do you think it's going to close at today? Anybody have an idea? And you guys can unmute yourselves, by the way, right? Make sure that mute is on.
5:15.
Are you able to unmute?
Yes, I was able.
Say 515.
Yes.
$515. All right. Let's see what's going on for Netflix. This is just part of the game, by the way. You said 515.
Yes.
Right. We're gonna see if we lose money. So you're saying that if I sell some credit over here, that I should be able to be home dry. That's this thesis right here, right? 18 cents, 21 cents. Who was that said 515? Vicky? Was that you, Vicky?
Nope, wasn't me. It was not me, Eddie.
It was Tasia.
Tasia, okay, Tasia. So there's absolutely no premium above that. So I wouldn't sell anything above that. All right. All right, good deal. The option chain, I want to spend a lot of time on the option chain here because last week we spent quite a bit of time on the calls side. Does anyone still have questions about what to find or how to read the option chain? Who has questions on that so that we can clear anything up? Out of the money, in the money, at the money. Does anyone still have questions on that? Anyone?
I have a quick question, Eddie. This
Sure.
is GP.
Okay.
Okay, so if we're selling a put, or okay, I guess my question is, like, how do I recoup my money now that I own that stock if I did an option? But I kind of really didn't want to own that stock, but
Yeah.
I do. So now that stock is showing up in my account. So do I just sell it regularly or like normal, or do I sell it as an option?
So the
I
scenario
gotta get rid
is
of it.
you bought a put. Is that the scenario we're looking at?
Selling a put, I think.
All right. So it sounds like we also need to talk about the terminologies here, right?
Maybe
So that we're all on the same page. All right, let me help you out.
Okay, thanks.
All right. So when we talk about options, there's two main words that no, I should say four main words that are used very, very often. Right. The one that comes to mind is buy, right? Buy means you're spending money. When you buy something, you're spending money, right? And when you buy a call, it's a bullish sentiment, and you're expecting that the price of whatever you're buying is going to go up, and then later on you're going to sell it, right? Somebody's going to give you money to offload what you already have, right? That's the buying part of it, right? The second word that we use is sell, right? So I already used it here when I said buy and sell. Sell means somebody is going to pay me money to give them something, right? And usually when you're selling something that you own. If you sell something that you don't own, it means that you're selling naked. That's not physical. It just means that you're going out to the broker, in, whether it's a TD Ameritrade or TradeStation or Webull or Robinhood, whatever broker that you're using, and you're borrowing something, you're borrowing shares or options, and you're selling them to someone. Why would you do that? Right? You have a sentiment here that says that when you sell them that contract, or that, yeah, since we're talking options. So when you sell them that contract, you're saying that, hey, look here, if the price of XYZ expires above or below, the strike price that we agree on, you have the right, but not the obligation, but you have the right to buy it from me for a certain amount, right? So I can either sell a call or I can sell a put, and there's two different scenarios on those, and we'll get to that shortly. When it comes to selling, we're going to figure out what side do I sell on, right? Do I sell on the call side or do I sell on the put side, and what does it mean? And then the other two terms that are used a lot is long and short. So when you go long on something, when you go long on a position, that is usually referring to you bought something. It's a bullish sentiment. And so when I say that I am long on Apple, or I am long on Netflix at 525, it just basically means that I have a call contract at 525 and I have a bullish sentiment. It means that I bought a call, and my thesis is that the price of Netflix is going to increase, right? That's going long. When I say I am short Netflix at 505, it means that I sold, right? I sold a call, or I sold I sold something for Netflix, and it's a bearish sentiment. So if I sold a 505 strike price at $8.60, my sentiment here is that I am expecting the price of Netflix is going to stay below 505, and I will benefit if at expiration the price does not come up to $505. I get to keep the $8.65. Last week, we talked about the multiplier, which is 100, meaning that each contract represents 100 shares. So it's not just $8.65, it is actually 865 cents. So in today's trading, right now, Netflix is trading at $514. And if I had a bearish sentiment, or even a sentiment that says that we are going to end up below $530, for instance, then you can see here that I can sell that sentiment that for right now $0. There's no value in that. That means the broker is agreeing or saying that, nah, that's the probability of that happening is so low, I'm not even going to put a value on it, right? The first time that they start thinking about that possibility is as the price comes closer to at the money. So notice at the money is 512, 515. Last week we talked about what at the money is. That is equivalent to current price, or approximately current price, right? And then in the money is any price, any strike price that is below the current price. That is when you're talking about calls. When you talk about puts, anything that is above, right? Anything that is above the current price is in the money. If you notice my screen, there's two colors or three colors. There's the purple background and there's the dark or the black background. Do you see how it alternates between the call side and the put side? Is that apparent to anyone? Anyone not see that? Hoping the resolution on my screen is good enough for that.
It looks good.
It looks good. Okay. And if I want to bring up, I'm going to bring up TradeStation as well, since I know a lot of you also use TradeStation. So I want to be cognizant of that. I'm going to drag my window here. And hopefully you all can still hear me. Can you still hear me? Yes, no, maybe?
Yes.
Can you hear me loud and clear?
Loud and clear.
Awesome. That is cool. Let's try and maximize this guy. All right. So I am going to look at the option chain for let's SPX, right? SPX looks like a really red day today. Very, very, very red. But not to worry. Never ever worry. Okay, let me increase this to about 40 to make it a little bit more interesting, and so you can all see. I am also going to reset my view to the default. Restore defaults. Oh, yeah, there we go. All right. So this one is kind of hard to see, but you notice there's a lighter shading at this level. You see that on the calls side? Do you see that lighter shading? All of that is in the money. And on the opposite side, on the puts side, right? All those prices above current price right now is 41.82. So anything above 41.85 is in the money, right? Any confusion about that? In the money and at the money. All right, there's no confusion. And then going long and going short. So we talked about going long, going short. We talked about buying and selling. So the question that you had asked was about, just to help you out here, when you say bought, what came to my mind is that you are long on a position. What symbol were you referring to, by the way? I'm asking the person that asked the last question.
It was just random, no symbol,
No symbol, right?
just the
So,
concept.
all right. So the concept you were trying to clarify is that what happens to those contracts or those shares that you bought, right? If you remember, last week we were talking about Apple and decided, let me actually just bring up Apple and continue that discussion. How about that? All right. We're just going to review this for just a few minutes. I think we were talking about the 134 strike. Obviously, price has gone down. So if you had bought a call contract on Apple, and that was the May 28th expiration date, if I remember correctly, it was trading at $5.05, if I remember, last week, right? And notice the price has gone down. So what would be the right thing to do if, or what would happen if you decided to close this position? You'd be losing some money, right? So remember that with options, it does not store any value. At expiration, it is worthless, $0. One day after it expires at 4:15 p.m. in the afternoon, your option contract, no matter whether it's a call or a put, is worthless, right? And before that time reaches, we want to evaluate what value it had before it expired. And that's what's very, very important. We have to think about the value of your contract before it expires. The teaching in general is that when we buy contracts, we buy them on a long-term basis. Long-term here means 2 months and above, or 60 days and above. So I'm thinking here 60 to 90 days. Even though we picked 28 days here, for example, the right thing to do is to buy something or to sell something 60 to 90 days in out. And why 60 to 90 days? Because that's the time period that during that time period, you have time to recover. So for instance, if you had bought Apple at 134 last week, notice that after just a few days, it's actually gone down, right? Does that mean it's going to continue going down the rest of the time? Not necessarily, right? It could bounce back up. So, this is a long answer to your question, but what actually happens is that you don't own the shares until you decide to exercise them. Exercising them means that you call the broker and said, you know what, I bought a contract and I said that I was willing to buy apples of share at $134. I am now going to exercise my option, right? And so go ahead and sell me Apple at 134 per share. And the broker is going to turn around and sell you 100 shares of Apple. They're going to take $13,400, even though the price of Apple right now is 131. Why don't they charge you 131 as opposed to 134? It's because your contract has a strike price. That was the basis upon which you agreed when you wrote the contract. The strike price was 134, right? $134. So that is the operating base at which all negotiations, all transactions are going to be based on. That is for single calls. That's called a single call or a single put. Whereas if you had bought 100 shares of Apple at 134, they would now be worth a little bit less. How much less? By $3. I'm just going to round down over here, or round up, 132. So you'd have lost $2 per share, or $200. Whereas if you had bought a contract expecting it to go up, but instead it went down, you would lose. Now, if you waited for this contract to go all the way to May 28 and you don't do anything, and the price of Apple remains below 135, then you will actually lose some money, right? I'm thinking about that. In the money. No, you will not lose. Yeah, you will lose money because you're out of the money, right? It's out of the money. So that's what happens at expiration date. You have to pay attention to whether your contract is above or below the current price. When it comes to puts, which is the second topic we're going to talk about today, we're going to talk about three topics, by the way. Calls, which is really just a review of what we did, or we talked about last week. That was a very bullish sentiment. We were talking about buying a contract and hoping, or our thesis was that it was going to go up, right? Respond to some messages here. Our thesis was that it was going to go up. Well, there are times when we have a thesis that it is actually going to go down, right? And let me look at Apple here on thinkorswim so that I can bring up a chart. And charts here. So what's going on here? So imagine if we bought a contract or decided that, you know what, Apple has reached its seller zone, and so it is going to go down. Let's draw some lines here and decide that this was its high and it is here now, and our next buy zone is somewhere around there, right? Something like that. Yeah, these lines are not very accurate. It could potentially go past that and then come down to this next chair. But let's indicate these V's over here. I like V's. Why do I like V's? Because those are strong zones for me. Those are strong support layers, support levels, right? So it could potentially come back down and then go back up, or it could, recover and decide to go up to the next seller level, which is now somewhere up there, right? Remember to do your charting well. This one is just a rough estimate of a zone. But if we decided we have a bearish sentiment on Apple, we could buy a put. How do we do that, right? The way to buy a put is to look at the current price, and we would buy maybe slightly above. We choose a strike price right above, so it's at 132. So I can either choose 132 or 133 or something like that. And I would go to my trade screen, right? And I would look at the singles. I'm looking on the puts side. And this is Apple, by the way. So I would choose this strike price. This seems close enough. And the ask is what I would choose, 37, right? That's the strike price that I would choose. The second thing that I would choose is the expiration date. Well, this one is expiring today. I don't expect that much more movement today. So you know what? I'm going to go out several more expirations. And let's continue with our example here of the 28th, right? Or we could just do it the way I'm recommending, which is go out a little further out, maybe talk about June or even July. I tend to go a little closer when I'm buying puts than when I'm buying calls. I'm going to take that back. I'll go with the 28th. And that is 28 days away from today. Did anybody catch that argument? Why pick the 28th as opposed to going 60 to 90 days?
Because of the volatility that could happen between now and then.
Right, but also the fact that this is I'm having a bearish sentiment on this one as opposed to a bullish sentiment. Now, we might have mentioned before that price comes down faster than it goes up for most things, right? things go down faster than they go up. I guess negative is usually a little stronger. So that is why I chose a shorter expiration date of 28 days, but I'm still giving myself enough time for my thesis to work. So I'm going to choose the May 28th expiration date. I already chose the 132 strike, and I can see here that the ask is $3.55. So I'm going to click one time on that, and I'm going to choose to buy these at $3.55. Let me adjust my quantity for today's exercise. We're just going to work with one contract at a time. So I am going to spend $3.55. Anybody can tell me how much total will come out of my account? Anybody have an idea?
$355.
$355, right? Or whatever price we get filled at. So right now, you see this open padlock here? That is saying that, you know what, get me this price or better. What is better? Better is actually lower than 355 because I am buying. I want to buy as low as I can and sell high. All right, this is a bearish trend. So just to confirm, I'm going to look at my chart. Apple seems like it's kind of struggling over here. I'm looking at the daily chart, by the way. Maybe I should drill down into the 1 hour chart. This is where we are right now. Really, I should have bought my put over here so that we can write it down, right? But for this example, we're just going to say that we're expecting that over the next several days, Apple is actually going to go down. Let's do the 6 months, 1 day. Do I actually think it's going to go down? Yes, I do. All right, so I'm going to confirm my choice, confirm and send. Can you all see this dialog that just came up?
Yes.
Okay, so this is saying that I am going to spend 355, which is going to be also be my max loss. So when you're buying or you're going long on a position, however much premium you use up is what your maximum loss is. So in this particular case, my maximum loss is $355, right? All right, I'm going to go ahead and save that or send that. And I just got filled at, how do I get, no, I go to my monitor screen, I got filled at $3.50, right? That is the way you do it in thinkorswim, and I bought one. Let's do the same thing in TradeStation. So in TradeStation, I'm going to minimize this a little bit here. Go to my March 28 date. I am going to buy a put at the 132 strike price for $3.50. I'm going to adjust my quantity here to 1. Choose my strike price. Here in the middle is $3.48. It's fluctuating between 348, 350. Let's just choose 350 here, which is the mid. Send. Once again, the math is the same, right? And my order has been sent, right? Did I get filled? How do I know I've been filled on TradeStation? I go to my orders. I can see here it's been received and that it's waiting to be filled. It's waiting to be filled. Let's go back to see what the price here is. Yeah, it's still sitting at 350. And that's the difference between some of these platforms. Some of them fill you in a little faster. Some of them take their sweet time. But you got me. You got me. I don't know why TradeStation just takes forever and a day. Price has moved away from us, maybe. Let's see, what's my strike price?
Eddie,
here?
I just did it and it filled.
Filled
for
at what,
me.
350
Yes,
or 355?
actually 355.
355, let's do a cancel replace. What's 5 cents between friends, right?
Right.
Here we go. All right, just got filled. How do I know I got filled? I had my phone ring. So I got filled at 355. That's my average price. So if you're in TradeStation, the positions tab is what I am looking at to see how much I got filled at, right? That's and I'm looking at the average price. Do you all see this column for average price? Right? And how much have I made so far? Big 2 cents, because the last price it reported was $3.57. So this has not caught up yet, but it should. Now, what should I do immediately after I purchase this? After I go long, what should I do? What's the right thing to do?
Put in your stop.
I should put in my stop or put in my buyback order, right? Depending on how I think this is going. Do I think this looks like it's a green candle? And since I have until the 28th, I could put in my stop now, or I could put in my buyback order later, right? What should I do next? It's flat. And I'm thinking, all right, well, let's put a stop. How about that? Let's protect ourselves. Risk management is more important than taking the profits. So the way to do that in TradeStation is to go ahead and check that, place a check mark on that line. And we're going to click on trade, right? See what I did? I clicked on trade, and then I'm going to change my order type from limit to stop limit. Okay, and it gives me more choices now, right? Gives even more choices. I went to trade and then I went to stop limit as my order type. I did not choose market. It is stop limit. And now I have to fill out these two boxes. Let me explain one by one. I'm not going to start with this one. I'm going to start with the stop price, right? So the way it works is that stop price is the price at which you want an order to be triggered. So since I bought it at 355, I'm going to tell the system that, you know what, if this thing actually goes to $3, right, and 20 cents, right? If if this premium drops to $3.20, I really need you to get me out. And how much do I want you to get me out at? Maximum I want to pay to get out at is $3. All right, do you see that? One of them is called stop price. The other one is called limit price. And I'm going to select good till canceled. So I want this to be in effect until for the next 90 days. That's what good till canceled is, right? Good till canceled. So right now the price is 352. So we're only 3 cents. We're not too worried. But if we get to $3.20, which is a very low tolerance, then it is going to actually take us out. Well, before I send this order, I want to see how has Apple, or how has this contract moved, so that I can set the expectation here correctly. How much has this contract actually moved today? So let me go ahead and cancel that for a second. I'm going to bring up a new tab. I'm going to bring up the chart for Apple, 210528, call 132. All right. And I see that it has actually dropped as low as 138. Sorry, as low as $3.36. Let me look at the daily chart for this. Do you all see that? 336 was the lowest it went today. Oh, I'm looking at the wrong thing. I'm looking at the wrong thing. We bought a put, right? AAPL 210528, P for puts, and that was the 132 strike. Much better. Yes. I am long at 3. How much did I pay for this thing? 355. Okay. So today it has actually ranged from as high as 379 to 293, 294, give or take. I think I should set these as my pain point, 290, right? 290, and maybe $3. I also see that I have the potential of getting up to $6.52 or even more, which it did on April the 9th, right? So this information is going to guide me for my stop. So now let's go back here to Apple, go back to my positions. I'm going to click one time on this thing, go to trade, going to set my stop limit, and I think I'm going to say $3. If it gets to $3, we're in big trouble. And do what? Try and get me out around 290. And I'm just giving it some time, some breathing space. So this says that $3 will be my trigger point. It's not actually going to get me out at $3. It's going to try and get me out at $2.90. The difference between doing these and a stop market, notice that when I do a stop market, market at, I don't even have a choice of what price to put in. So it's not a really controlled situation. And that is why you always want to choose stop limit. Then you can decide what your actual exit is going to be. So $2.90. And if you have questions on these, by the way, now is a good time to ask. Why did I
Yes,
choose
hi,
$3? Yeah.
Eddie, I just sorry. One quick question. I missed when you went to go access the Apple contract premiums chart. How do you access that? Is that available on Thinkorswim and TradingView as well?
I don't know on TradingView. On TradingView, you can only do stocks.
Okay.
No options. On thinkorswim, you know what? I haven't tried that, but we'll look around and see.
Okay.
Right. And but it's a really nice feature to kind of give you an idea where has the price been for this contract, right?
Right.
The other way to do it, if you don't have access to TradeStation,
I do. You can show me through TradeStation. TradeStation.
Right. Okay. So there is still one other option for those who don't have TradeStation, and that's barchart.com. Right. And we'll actually do it just so that we can see that. So let me go ahead and send these. I call this my risk management order. Right. This is my risk management order. What I am saying here is that my estimated credit here is 290 based on the price of $2.90. We are selling to close, right? Selling to close. Why is it selling to close? Because to get into the position in the first place, we bought to open, right? Bought to open. So this is important. If you want to take a screenshot of these so that you can understand it later, I think this terminology here is very, very important. We're selling to close at limit price of $2.90 because our stop price is $3. Do you all see that? Let me draw something around here so that you guys can see what I'm reading. I'm reading this sentence here, or that section. Right. That's one of the most commonly asked questions. How do I set a limit or a stop loss on my options? That is how we just did it. Any confusion? Any thoughts on that? And I'm just going to go ahead and click on send. So that order is there now. And another question that is commonly asked is, well, I've got my risk management position in there. Can I now go in and put in my take profit order? Can I go in and put my take profit order? And the answer is not on TradeStation. On TradeStation, you actually cannot go in and put in your take profit order because you already have an order in process and it is going to tell you that you are already one long, or you're already one short, whatever the case may be. So if I try to go in to that order line again and see, clicked on trade and put in limit price, say I want to sell this now at $6 because, or $6.50, because I know that it could potentially go up to 60 or $6.50. Let's see whether that will happen. Limit. Do you see that? That message is very common and people don't understand what it's all about. Order failed, reason you're long one shares with one remaining on sell orders, exclamation. And that's because you already have an order in the opposite direction. So you cannot have both at the same time using TradeStation. But using
Eddie,
it, yes.
I'm sorry, that's the case for desktop as well as the web version of TradeStation?
It is possible, yes. I believe that is the case, yes. Yeah. So you have to figure out which one is more important. Is the risk management more important for you, or is the take profit more important to you? If you just have your take profit order, then you're risking that when this thing goes the opposite direction, there's nothing to stop that falling knife, right? In my opinion, I think it is more important to protect your capital than to go after what you really don't have. Does that make sense? One hand, I mean, a bird in the hand is worth two in the bush. So always try to protect your capital. Let's look at that risk management order one more time. We put in an order that will potentially take us out at $2.90, right? And we bought this at $3.50, $3.55. So 3.55 minus 2.9 is 65 cents. And we bought one contract, so we need to multiply that by 100, which means that our potential loss here is $65, right? You with me so far? $65. So if all these was to go against us, we would lose $65. Now, here's the kicker. If we start making money, and I can see here we are fluctuating between red and green. If we start making money and we're now $100 in the green, for instance, what we should do is go back to our orders and do a cancel replace and increase these numbers, right? We should increase these numbers so that we can protect what we have already gained. So for instance, if the price of our premium has already gone to $5 and we're expecting that it's going to go all the way to $6.50, but we want to protect that $1.50 that we have already earned, then the right thing to do is to go in, do your cancel replace for your risk management order, and then just do increase that maybe to $5, and that's to $4.90. Does that make sense about how to do that? Anybody confused about that? No questions on that. All right, great. Let's see how our trade is doing on thinkorswim. So on thinkorswim, we're back to the monitor tab, and there is a positions statement. Notice here that we have it's listed by, or it's grouped by instrument. So Apple, it looks like we are $5 short, or rather we are $5 down, just like we saw on TradeStation. So they're kind of in sync. We're now down just $2.50. Let's go ahead and put in our risk management order on this one. So what I will do is right click and create a sell order, right? Actually, this is not the way I actually do it for TradeStation. Sorry, for thinkorswim. For thinkorswim, there's actually a better way to do this. There's a much better way, and that's the way that I'm going to show you. So, but let me show you first the poor man's way. Poor man's way is just to create a closing order, click on sell, and then put in your price here, right? What was our price? $2.90, and then confirm and send. And don't forget to change that from day to GTC, right? Otherwise, if you leave it at day, this order will only be good until the end of the day, until 4 o'clock. It drops off. It's not even going to go into after hours, into the post market, right? It just drops off. But when you put good till canceled, this order will pause at 4 o'clock, and it will be re-entered automatically for you at 9:30 in the morning on a trading day in the morning, right? And it's good. That order is good for 90 days, right? 90 days. So that is what I'm going to call the poor man's way of doing business over there. Let's find a better way. A better way is use the default tools that thinkorswim provides for you. In TradeStation, we discovered that we can't really do an OCO order on options very, very well. It's kind of cumbersome, right? But on thinkorswim, guess what? We can actually do an OCO order. How do we do that? We're going to use the same example that we chose over here. We're going to be bearish. We're going to buy a put on Apple at the 132 strike price. Okay. And we are going to put in an OCO order. I am going to right click. I am going to buy custom. I'm going to select OCO bracket. Does everybody see that? I can't see your faces, so I'm just going to assume yes, because I'm not hearing a no.
Yes.
All right.
What strike was that again, Eddie?
The 132.
132. Thank
Yeah.
you.
132. So we're just buying a put. This is an example trade, and we are having a bearish sentiment. We are saying that Apple will potentially go down in the next 28 days. Not necessarily today, but in the next 28 days, we expect Apple to drop in value, at which time we will profit because this put contract that we're buying will increase in value. As we can see that it's already increasing in value by 5 cents, right? So here, this example now is getting into the trade, putting in our risk management, and putting in our profit all at the same time. Imagine that. Imagine that, right? So how do we do that? Let me delete this and go it one more time because I think this is super important. I right click, I am on the puts side on the ask column. I'm going to right click. I'm on this line here for the 132, which is the strike price, right? So I right click, I buy custom, choose with OCO order. Now there's different scenarios for these other ones, but right now we're just going to go with OCO bracket. And now I'm presented with an order screen that says, this is the price at which you're buying, right? The 460 is the price that it is going to close. It is going to sell it at $4.60. That means I will only make $100 since I'm buying one contract. Well, let me change this, by the way, to just one. Make sure we're working with just one today. All right. So that was just adjusting the quantity of the number of contracts that we're working with. So right now, thinkorswim is saying that, you know what, we can buy these for you at $3.60. By default, we are going to try and sell it for you at $4.60, meaning that you will have made just $1. But we're not comfortable with $1. We think that it's worth a bit more. So let's go ahead and increase that to about 5. You know what? Let's just go all the way to 6. You know what? That's too many clicks. Let's go with 5.5. Right. So we're going to make $1.10 on that if we can. And what else? What else is our market order? Now I am fairly confident in thinkorswim that when I tell it to get me out at around 260, it will usually try to get me out at 260. TradeStation, not so confident, right? That's just Eddie's thoughts. results, your mileage may vary. So I've got my take profit order. This is what my order number 2 is. And I've got my risk management order, which is my market order. Take me out if I am losing by $1. I could adjust this number here to match my tolerance or my risk profile. So you can go up or down based on what you would like or what your trading plan says. The other thing that I need to do is change these to good till canceled. All right, good till canceled. So I'm going to choose that GTC right there, GTC over here, and let's see whether this is going to actually work. Market orders with a good till canceled may not work together, but we'll see. We'll see how that works. And then I will confirm and send. Pay attention now to this order confirmation dialog. You notice that I am putting in 3 orders at the same time. Do you notice that I'm buying 1 and order number 2, which is triggered? That's what that TRG means. It is triggered by number 1, meaning that it will not happen before the number 1 order happens. And then order number 3 is also triggered by number 1. So only one of these can happen after this. Right? And then there's the usual calculation. My maximum profit is $12,840. Why is it $12,840? Anybody have an idea? No one has an idea. Okay, I'll let you know why. Oh, go ahead.
No, I'll listen.
Okay, so this is a bearish trade, and we're saying that we think the price of this underlying Apple will go down, right? And if it goes down, what is the lowest it can ever go to? Right? The lowest it can ever go to is 0. Yeah. And so the system has calculated for us that if we get in at 134 and it goes all the way to 0, which is very unlikely for this company unless something happens and just, I don't know what would happen for Apple to go down to 0. This is the maximum profit that we can get out of this one contract, right? And what's our max loss? Our max loss is $360, which is pretty much how much we're paying for it. Remember, we are the buyer of the contract, and so we have the right, but not the obligation. But the guy on the other side, or the lady on the other side, has got the obligation to sell it to us if we choose to exercise that right. Right? It's rare, but it does happen, and there are situations where that happens quite a bit. So I'm going to go ahead and send that order. And of course, since the price is now 370, it's unlikely that it's going to be filled. How do we change that? We can go to our working orders, and we can change that. Let's go ahead and cancel replace. We're just canceling that one. We're going to unlock this price, confirm and send. Go. All right, that one's sold. Did you all hear that beautiful sound? Yes, no, maybe. All right.
Yes.
All right, cool. So now that that is sold, so you can see this link has already been set up. Let me go to the participant screen here. I see we've got hands up. What's up, Bob? You've got a question? No questions. Okay, that's fine. So
thank you. Thank you, Eddie.
Okay. Do you have a question?
Yes.
Okay.
I had wanted to ask you if you can clarify in the order you placed before. There are 3 lines there. If you can emphasize on the lines, like the one that puts into the trade, the one that creates your limit, and the one that takes you out of the trade. Okay, so there were 3 lines, you're correct, meaning that there were 3 orders. An OCO is actually composed of 3 lines. One is your entry, the one that we used to enter the trade. The second one is your take profit order, which is this one. Okay.
right? So I put in my take profit order, and I told the system that once you get to $5.60, please take me out, because I will have made approximately $2, give or take, right?
Mm-hmm.
And then the third one is my risk management order, which says that if this trade goes against me, and I told it that, you know, whatever the base was, I don't want to lose more than $1, so 370, right? If it goes down by $1, please take me out. That's just what that is.
Okay.
Yeah. So you can do this in thinkorswim all in one order. Do you see that? It's so easy in thinkorswim. That's why
Yeah.
a lot of people are liking it. Let's take a look and see what's happening to our the other side. I'm going to go to my positions tab. Look at that. We've made $10 in the time that we've been talking here. We've made $10. So our thesis continues to be correct, that in fact Apple is reducing in value, and our premium has increased from $3.55 to $3.50. Sorry, did I say that right? Yeah, $3.55 to $3.59. So far we've made $15, $10, 15 maybe.
And Eddie, we can exit right now if we just wanted to, right?
If you wanted to, yes, you can. If you wanted to, you could well, actually you would have to go to your orders and cancel this order first before you can exit, right? Remember that we have our risk management order here. And who was that? Who asked that question?
GP.
Hey GP, all right. So yes, we can we can decide, you know what, $10 is or $15 is good enough for me, right? And you know, I'm happy to make $15, you know, $20 now. Oh, look at that. Yeah, $20, and forget about it. All right, here's a word of caution. If we get out now, do we use up a day trade?
Yes,
Yes.
Okay. Why is that?
because you bought and you sold in the same day.
We entered a position and we exited that same position in the same business, in the same trading day, right?
Correct.
So if you do that, what we just said, and you're happy with $20, then you also should be happy with losing or using up one day trade, right? But if day trades are not a problem, say you have over $25,000 in your account, then not a big deal. Now, if you had bought 10 contracts, then you can see here that all we have to do is just add a zero, and you could have made your $2,200 in the time that we've been talking. A lot of people do that, right? A lot of people do that, maybe 2-3 times a week, and they're not under the PDT rule, or they have PDT rule, but they only want to make their $200-300 3 times a week. You can do that, right? You can totally do that and not be worried about the day trades. So this is, again, for example only. So it looks like we're winning. That's a good thing. Anytime that you are above or you're seeing green, it's a good deal. It's a really, really good deal. Since this contract expires on May 28th, we have a little bit of time. Yep, we have a bit of time for this to increase. But I think we'll get out by the end of the day. We'll use up a day trade here on our SIM account, no big deal, right? But you've got room to fall here. You've got room to make profit. And our thesis here is that we will continue to see this downward trend. Most likely, we're going to settle around 130 here by the end of the day, right? So let's go ahead and let's see what Apple is doing on thinkorswim. So I'm going to go to my monitor screen, and look at that. We are up $40. Why are we up $40 and the other one we're up only 20? It's because we have 2 contracts. right? We have 2 contracts, and let me turn on my numbers here because this is just the SIM account and I don't need to hide so much. All right. All right. I wanted to see here that my open profit and loss is $40, right? So how do we get out of this position immediately if we decided, you know what, I've had enough. I've had enough, and $45 is good enough for me, right? How do I get out? What we could do is simply right click on these, create a closing orders, and sell both of them at the same time, right? And what's going to happen? It is actually going to execute. But since I already have an order in there sitting in my monitor screen, all I could do is really just go to my take profit order, which is this one right here. I will right click and I would cancel replace order. And instead of having this lock for the price, I would click on it to unlock. And right now the price is at is between 380. It's actually at 380. So I could where's my red button? Yeah. I could just put in a price of 380, which is the current price. Is that right? Is that right? No, that's not right. Five. All right, I was expecting this number here to move, but it is not moving. Why is it not moving? I don't know why it's not moving. So anyway, I'll put in $3.80 and go ahead and confirm and send. But I don't want to do that. I'm going to have a little bit of fun with that. What have we covered today so far? We've covered buying a call, buying a put, how to do your risk management, how to take your profit, how to enter the trade, how to exit the trade. What haven't we covered in calls and puts? This is options 101. So any question is game. It's fine.
Can you show us how to exit the trade in TradeStation?
Yes.
I know you said you have to go to the orders tab and cancel it first, but you stopped right there.
Yes. So you know what? We made $25 in TradeStation already, right? So we're happy. Yeah, we were really happy about this. We've never made 25 bucks. Let's go to our orders. Remember, this is TradeStation web. There's a little bit different way in doing this in the desktop version. I am going to go ahead and cancel this, the big X. See that big X right there? I'm going to cancel the order. Proceed. So now I have no orders in there. I'm going to go back to my positions screen, right? And notice what the last price here is. Do you see $3.75? Right? So I'm going to trade and make sure that this says sell to close, right? Sell to close. And I'm going to choose the mid price of $3.80. Let's see whether that is going to get us filled and send orders. The estimated credit is going to be $380. Send. And now we're just going to sit over there and just wait. Right now, the price was fluctuating between $3.75 and $3.80. If we decided, you know what, I really just want to get out at $3.75. I don't want to wait for it to go up to $3.80. We could go back to our orders and do a cancel replace and change the price to $3.75. Right now the mid is 377, so let's see $3.75. So what are we going to fill? We just got filled. Now, if I go back to my position screen, everything is sold. I should now go to my balance and see that my realized profit is $18. Why is it $18? Because the broker has already taken their commissions. Does that answer your question?
Yes, thank you.
It does. Okay, good. So that is how you get in and out of a trade using TradeStation, right? We bought low, we sold high. Now, normally, would we just get out at just 20 cents for $20? Normally not. We'd let this play out a little longer because I could have achieved the same thing by buying a shorter expiration contract, right? So as you do your planning, as you do your charting, you probably want to go out a little further so that you can get the benefit. Somebody asked me a question: how do they see the option chart in TradeStation? Right? Somebody asked that question. Let me show you how to do that. And
yes, that was me, Eddie. Thank you.
awesome. That was you, Kenisha. All right. I'm going to show you how to do that. So in TradeStation, remember that you can just click anywhere on the chart and start typing, right? So if I just start typing here, Dell, it will, and I hit enter on my keyboard, it is going to bring up the chart for Dell. I don't have to actually go over here and try and be very accurate with my mouse and all that. I can just click anywhere on the chart and click, say, W and hit enter if I know the symbol, right? So that is also true that if I know the symbol for that option, then I can start typing it. So in that case, AAPL space the year, which is 21 in two-digit form, the expiration date, which was 05/28, and then I choose a C or a P, C for call, P for put. This was a put, and then the strike price, which was 132. Enter. Right? And I can do that with any dates, any symbol, anything that that I can trade, basically. Does that make sense? And,
yes, thank you
then,
so much for explaining that.
You're welcome.
I didn't know about that feature.
Yeah, you can do that. And you don't have to be in the trade. Let's bring up another chart, for instance, for Netflix, right? NFLX space 21 maybe expiring today. Pretty sure they have a call that is at 5:20, almost certain 100%. Yeah, there we go. It's trading at 2 cents or 4 cents. Yeah, stay away, man. Don't do it. Don't touch it. Don't even think about it. Yep. I saw a chat. I saw something here. To place a trade today, you want us to place a trade on Netflix? Is the request? Okay, we'll take a look at Netflix. So that was. Before we do that, I want us to also talk about verticals, right? That's the next thing that I wanted to talk about, verticals. Reason I want to talk about verticals is because it was introduced on Tuesday. So hopefully you have already gone through the curriculum and you've read up the section on verticals. You already listened to Chris and you know what a vertical is. And so today is just a review. We're going to go over the finer points of what verticals are and how they are used. But first, I want to hear who has a good explanation or any explanation. Let's start there. Who has any explanation about what a vertical is? So remember how the teacher picks on someone?
So can I give it a try?
Yes, please.
Great. So a vertical, just conceptually, the idea is rather than selling a naked call or a naked put, the vertical has you also buy a call or a put, depending on what direction you're going, to protect you, so that if the trade goes against you,
right,
you only lose the difference between the two strike prices as your maximum loss.
Okay. It's a good explanation. All right. Anybody else have a different way of explaining it, or?
I'll just add to that the second leg is your insurance leg, so that
What's
you
your
don't
first leg?
what you're shorting, or and then you're
Okay.
long on the second leg.
Your long leg. Okay, so your long leg is your insurance.
Yeah.
Okay, good. All right. All right. All right.
Hey, that just helped me. When the way that you phrase that, the second leg, we should think of that as the distal. Is that okay to think of it as the distal leg? Like your proximal leg is like, is that an accurate way to think of it?
You could, even though I think of the long leg as my first leg, right?
Okay.
I always think of my long leg as my first leg. And the reason I think of it that way is because when you're entering a trade, depending on what level you are or you have, you cannot really execute the fast one, the short one, before you have a long position. Otherwise, you would actually be selling naked, right? You'd be selling naked if you try to do that. So I always think of it as the second leg. But to be more precise, a vertical consists of two legs, a short position and a long position. So let's go ahead and bring up let's bring up afraid to do this, but let's do it. All right. I am going to bring up a famous symbol over here that we just discovered. It's called SPXW.X. And why is it famous? It's because it has an interesting profile, really interesting profile. So think about this one more time. I'm looking at AMZN. AMZN. I'm going to go with AMZN. You guys have heard of AMZN, Amazon, right? Amazon. I'm going to go with Amazon.
You mean AMZN?
Amazon is AM Alpha Mike Zulu November.
Okay.
Amazon. Right. How do you open the options chart on desktop? On the desktop, options chart on the desktop. So on desktop, I'm assuming that you're referring to the one that you actually install on a Windows machine. Is that right?
Yes.
So, okay. All right. I will find out and let you know because I have no idea.
Okay, thanks.
Under Options Station Pro.
Yeah, and the reason I have not too much knowledge on that one is because I as you can see, I'm on a MacBook, and I don't have access to the Option Station Pro unless I switch to Basecamp, which is a big pain. It does not add any value for me, so I don't bother.
Okay.
Yeah, I've got thinkorswim, which does a lot more. So let's talk about verticals, right? Now, I want to buy. I'm in the option chain for Amazon here, and by the way, I'm going to get implied volatility out, volume, open interest, theta, and I'm just going to leave delta on that option chain so that we can at least see something. So Amazon is currently trading at approximately $3,480 and change. So it's right here, and I want to make some money on Amazon as it either goes up or goes down. And I'm looking at an expiration date of April 30th, which is in approximately 29 minutes. So I have a thesis that Amazon is not going to close above 3,600 or 3,550, right? 3,600 or 3,550. So how do I construct a vertical? If I constructed a vertical manually, what I would do is I would buy, first I would choose the strike price. I'd probably go with 35, 50, 35, 55, give or take. Let's see what the vertical, it's a 5-point wide spread. Oh, by the way, does everybody know how to get to the spread? Because I've seen on Facebook, people don't see this option. So let me talk about that for a second. The way to get to the vertical option here is, if you don't see it, just click on all, and then on the dialog that comes up, just select vertical, right? It's the same one. Anytime that you see vertical, it's the same thing. So just in case you don't see it on your TradeStation web. And if you're on thinkorswim, the way to get there, by the way, let's go back to AMZN here. To switch from singles to verticals, you would pretty much click on single and vertical. And now you've got a vertical spread over here, and it's 5 wide. And you can choose to see how many you see up and down. So let's go back to TradeStation. So I want to construct a vertical here that expires today, right? Rather dangerous. This is called 0 DTE, 0 days to expiration, right? That's what DTE means, days to expiration. I could also choose 7 DTE. So I want to give my thesis about 7 days to work, right? About 7 days to work. And we'll see what the difference is. Right now, at the money is approximately 34.85, 34.90, right? Why is it 34.85, 34.90? Because that's where the current price is. We all see that? Remember, we've talked about this so many times: at the money, in the money, out of the money. Right now, at the money is 34.85, 34.90. And so the thesis here is that we want to, if we have a bullish sentiment on this, then we're going to sell. We're going to sell a put credit spread. Pause there for a second. If we think the price of, and I said that backwards. The minute it came out of my mouth, I said it backwards. If we have a bullish sentiment, meaning that we expect the price of Amazon to continue rising, then we would sell a put credit spread. Why do we want to sell a put credit spread? Because we believe that the price of the underlying is not going to breach or enter our short leg. Remember, your short leg is always the one that is closest to the strike price that you choose, or the current price. Are you with me so far? Now, if we were bearish, on the other hand, meaning that we expect Amazon to continue going down, then we would choose to sell. We would choose to sell a call credit spread above it, right? And we would choose our short leg closer to the current price and our long leg further away. Whereas if we were on the other side, horizontal line, you can tell I don't chart too well on the TradeStation. We'd pick one somewhere down here. So now that I'm looking at the candlestick over here, and it looks to me that it's going down, help me think here. Should I go for a call credit spread or a put credit spread? And then we can go from there. Nobody wants to talk. All right. So we would go for a put call. Got 50-50. All right. We would go for a call credit spread. Why? We don't want to trade against the momentum. We don't want to trade against what the market is telling us. What is the market telling us right now? The prices are dropping. So I want to be above where the price is so that I can maintain that position and guarantee not, well, of course, closer. other price is 34.84. So I am going to go to 34. My internet connection is unstable. All right. 34.75, 34.80, 34.90. I'm also looking here to see what kind of premiums that I can get. So 34.95. Since this is for example only, since this is just for example, we are going to pick 34.95, 3,500. 34.95. No, not good. It needs to be above 34.80 or 3,500. There's actually no premium. 3,500. All right, let's just pick 3,500. So 3,500. This is really poor premium, and I'm also going to.
I'm sorry. Can you talk about why you're saying there's no premium? I can't quite see your screen. I'm sorry.
Okay, so I am looking on the bid side, the red column on the calls side, which tells me how much premium I could potentially sell these for, right? And I can see here that if I sold it for 13 cents, there's not too much that I can get. Let me see if I have a spreadsheet here that I can share. One second here. I'm just going to queue it up and then I will talk about it. All right. So for Amazon for today, it's not looking very good. So I most likely would not waste a whole lot of time over here. So let's go to 7DTE, which is next Friday, and look for premium. And we can talk a little bit more about that. So next Friday, if my thesis said that Amazon is not going to go above 3,600 or 3,550, then I can look for premium above 3,550. Notice that here it's giving me a premium of 90 cents. You see that? 90 cents. And if by next week, the price of Amazon closes below 3,550, then I get to keep all 90 cents. Or $90 if I bought one contract, or 900 if I sold 10. Right? 90 if I sold one, 900 if I sold 10. But that's not a really good risk reward ratio, because the risk of Amazon, which moves even 70 points in a day, that could be breached, even in overnight trading, right? So that's not a good risk reward ratio. So let's go back to our other example, our other choice here, which is SPX.
Okay.
And I think people will like SPX because they've heard about it, which expires today. And for this one, we're also going to check to see whether we can get any premium expiring today above. Remember earlier we played a game and people were putting in bets about where they think that SPX is going to close today. Right now it's we've got 20 minutes. So we'll try and get this example in within 20 minutes, right? So we've had a very bearish day today, meaning that market has been going down, and the right thing to do would be to sell a credit spread, right? In the morning would have been the best time to do it because the premiums were a little bit better. Why are they better in the morning than in the afternoon? Theta. Remember, we talked about theta last week and discovered that theta will eat away into the premium, starting at around 2 weeks to expiration. And then on the day of the expiration, it exponentially just destroys the premium. So at this time, 20 minutes to expiration, we are not going to get too much without risking a lot of money. Not a good way to trade, but for this example, we're going to actually do it. And I mean, sim, do not try this in live. Do not try this in live. Okay, so right now price of SPX is 41.80, and we want to look for premium above it. So 41.95. We can probably get 5 cents. We can get 30 cents. Let's just go for 30 cents over here for 190. And we're just going to do one contract. We're going to talk about why we would do this. If I want to sell XPS, sell just a call on SPX, I would have to come up with 4,190 times 100, which is a huge amount of money, right? We don't have that. In any case, you cannot even do that with this ticker because it is actually an index. You can only use options to trade this kind of symbol. Whereas with an equity like Amazon or Apple, you can buy shares. This one has no shares, right? Indexes have no shares. There is no assignable instrument that is going to be, pegged to your account and you're told, well, you have to buy it, right? At the end of the day, this one has no value. So if you lose money, they just take that amount of money in from your account. It's called cash settled. A little bit more on that. If I want to get into these leg by leg, remember we said we're going to choose a position. It's 190, right? 4190 is the one that is my short leg. 4195 is the one that is my long leg. As we're speaking over here, the value has gone from 30 to 15. So we're not going to get too much out of it. Let's see whether we can get one at 20 cents. Get $20. And we just sold it, right? We just sold one. Here's the big confusion. Am I actually making $269 from this one contract that I sold? No. No. How much am I making? 20 cents or $20. Big confusion. Why is it showing me $265? That's just how much whatever individual here is trading, right? But you know what? In SIM, oh my goodness, 460, 4.6 minus 1.75. Yeah, this is the problem with SIM. You can already see that. If this were real life, this would be very, very good. But how much do we know that SIM filters for? Look at this column here. Let's break it down. The average price is, remember there's two legs involved, a short leg and a long leg, right? We sold this leg, which is short, for $4.60, right? And we bought it for $1.75, which gave us a net credit of $2.85. Is that realistic? Based on what you see here in the options chain? It's not. And that's why you should never trust the SIM to give you good value. The SIM is only good for practicing how to do stuff, especially when it comes to verticals. So no, you're not making $277. These numbers are unrealistic. You will never, ever see them in live. In fact, to demonstrate, look at the last prices over here. This is more real. 20 cents or 15 cents minus 7, right? That's 8 cents. Am I driving this point home? Is it making sense?
Yes.
Right. So don't trust on the sim to give you real numbers. These are not real numbers, and that's why I had to do that, just to show that it's disappointing a lot of people to think that you can practice 10 times, get it right in sim, and expect those same numbers when you go live. Now in TradeStation sim, you can expect real numbers when you're dealing with just equities, right? In our Apple example that we did 30 minutes ago, we actually did make that $20 or $25, right? And that's more representative of what you would make. By the way, let's go ahead and check what our
Before you go from there though, Eddie, on there, would you take the 19 minus the 15 and say you're making 4 cents?
Yes.
Okay.
Mm-hmm.
Or $40.
Yeah, so 20.22 minus 0.07,
$4.
15 cents. Yeah. So 15 cents is your real profit right now, times 100. So that's $15.
Okay.
Right.
Thank you.
And if you don't do anything, this is going to expire worthless, meaning that you're going to get to keep the 20 cents that you should have received in real money. But since the sim gave us an astronomical amount, which is not realistic, don't think in terms. In fact, if I go to my balances here, let me see, where's my, turn this off. Notice that, what was it? See my unrealized profit, $234. Yeah, that's not accurate. It is not accurate at all. So pay attention to that and know that the sim is giving you information that is out of this world. It does not happen in the real world. I can't stress that enough. The sim environment is just for you to practice how to use a trading platform, where to click, where to go, how to read charts, how to read the option chain. Yes, you can practice with equities. When it comes to indexes and all that, don't expect that those field values, the values at which it is filling you, are real. This can be very, very confusing for people coming in and you think that you made 1,000 a day. Nope, you did not make 1,000 a day, right? If these are the kind of numbers that you're getting, you did not. We've got 10 minutes to expiration. So that was that. Let's go to real quick to our monitor screen here on thinkorswim and see how we're doing. So far, we are up $45. Is this a good thing or is this a good thing? It's only one.
Depends on how much you're looking to make, but I would say yes, because it's positive.
Correct. You're not in a negative.
Yep, I'm not in a negative. It continues to go. See, AAPL. Yeah, we had a thesis that Apple is going to continue on a downward trend, and so we're going to make money as we go along. So this is a thinkorswim simulated trading platform. So I think we're still on track. And our expiration is May 28th. I'm going to check on this one on Monday and see how it is, and maybe even get out for a small profit. Right now we are up $45, I think. Make that $55. Yeah, make that 55. So going back to our verticals demonstration there, we see that those numbers are not realistic. But let's really talk about what a vertical is and how to construct it the manual way so that you fully understand what's really happening. And for that, I am going to go back to Amazon. Okay, and I'm chain for Amazon. I am going to change from single to custom, and we're going to talk about all that insurance leg and that kind of good stuff. So here's what I'm going to do. I selected custom spread, right? How did I get there? I just clicked on that down arrow over here and I looked for custom. I found it. I clicked on it. And my thesis is that right now Amazon is selling at 34.66. Let's just assume that we don't expect it to go to 3,500. So I'm going to pick up a 3,500 short leg on the calls side. So I'm selling the 3,500 and buying the 35.10 or 35. So I'm going to sell the 3,500 and I'm going to buy 35.05, right? That's the manual way to do it, right? That's a manual way to do it by individually selecting those prices. You have to be very, very careful about what you're doing when you're doing it this way and be very accurate. And that's why it's a lot easier if you just click on verticals and construct it like that. Notice that the kind of premium that I'm getting, I'm selling that I'm not getting a lot of premium, so I'm going to go out a little further. Nope, maybe even go a little further. There's pretty much no premium right now. Now, the further these two legs are apart, the riskier it becomes. The riskier it becomes. So you always want to stick with a 5-point spread. And the safer way to do that is really just instead of doing custom, just do vertical and then let the system do it for, do it really clean for you. And when you see a minus here in front of the value, it means there's no premium. Nobody's going to sell it to you. Even the system will not allow you to place that trade. So the reason that is happening is because we have about 5 minutes to end of the day. So we're not actually going to go into an Amazon trade. Now, how do we do that in thinkorswim? In thinkorswim, let's go ahead and use the SPX as our example again. So I'm going to go to trade. I'm going to choose SPX. By the way, on thinkorswim, the symbol is SPX, just like I said. Everybody says SPX. When it comes to TradeStation, the symbol is actually $SPXW.X, not to be confused with another one called SPX.X. A lot of S, a lot of X. One's a monthly. Which one is the monthly? That's the SPX.X. I'll pause there for a second. Which one is the weekly? It's the SPXW.X. So just think of the W in there and you've got the right one. The W is the weekly. That's the one that is very, very popular, the one that we trade mostly. So on this one, I'm going to open up the option chain again and make sure that I am on vertical spread. How do I get there? By choosing vertical on the spread. Do a time check here. And then look for the current price, which is now 41.80. And the thesis is that today is actually a bearish day. So we would be looking for a call credit spread, meaning that we would go above 41.80 to sell. We'd be looking for premium on the bid column. As we can see right now, there is barely, there's nothing at all. So we're not even going to get into a trade without risking a lot. And I don't want you guys to be in the business of risking at this time. The best time to get into a vertical spread when you're selling premium is when the market is a little volatile, meaning there's a lot of volume happening in the market. And also you have enough time to recover in case your trade goes against you, right? So two things. Make sure, one, that you've got your market momentum correct, and also make sure you have enough time. How much is enough time? Usually more than 0 DTE. If you can get it, that's much better. So in fact, to practice what we're preaching, let's actually choose 14 DTE on this one, and I'm going to go with 42 or with something above 4200. And my thesis here is that in 2 weeks, I'm going to go on the other side, right? So in 2 weeks, my thesis is that we are not going to close below 41.15. So I'm going to sell a put credit spread for 70 cents, give or take. Well, actually, it's going to give me $1 here. So I'm going to lock that in, and I'm going to confirm and send. Let me just go with 1 for this example here, since this is a training class, right? $1 here, confirm and send. And it should sell here momentarily. There we go, it just sold it. I love thinkorswim, it sells it very, very fast. So what just happened, right? We sold a put credit spread 14 days in advance for 70 cents. What is the 41? What is the 41.10, 41.15 doing right now? Let's go to today's expiration, 41.10, 41.15. It is worthless. You with me so far? I sold it 14 days in advance because I could get $1 for it, right? And I know that, or I have a good feeling or good math that as time decays between now and 14 days, I'll be able to buy it back for around 20 cents or just let the thing expire worthless and I get to keep the $1, right? So $1 multiplied by whatever your portfolio size is. If you normally sell 2 at a time, 5, and so on and so forth, then that's the math that you would do. In fact, I started building a spreadsheet here that let's see whether this helps. This helps. So let's look and see if I want to keep 10 cents. Can everybody see this spreadsheet, by the way, that I have?
Yes.
Okay. I started building this one today. I'm not done yet. But if I want to market close, hang on a second. Let's see what our game is. 41.81. Who was closest today? Who won today? Jay won 41.80. You're the closest right now. 41.85, 41.89. All right, 41.81 is the closing. Price for SPX. I love that that game, by the way. All right. So assuming that we got $1 credit, right? What would be our profit? So let me just copy this formula here. And I'm going to change the values here. It's a there ought to be a better way to do this. Pretty sure there is. Yes. All right. And let me explain it. Go ahead and hide that. And I'm going to also hide this. We just sold premium and we received $1, right? $1 premium on one contract. So what exactly is our profit going to be? And my spreadsheet here says that it is going to be $93.60. When everything settles, that is how much I will receive, $93.60 in my account, right? What if I had bought 3 of them? Then I would have made I would make $280.80. How do I get there? if you look at my formula, I am multiplying. I am multiplying 1, which is the premium that I received, times 100. 100 is the multiplier that we all know that one option contract represents 100 shares. And then by multiplying that again times A4, what is A4? That is the number of contracts that I sold, right? And from that, I am subtracting, right? A4 again times 1 times 1.6. And what is 1.6? 1.6 is the cost, that's your commission cost. I like to know how much it cost me to do business here. So when you sell one contract, it will cost you $1.60 to open it and $1.60 to close it. That is an index. This formula is only for indexes. If you want to apply it to equities, change the 160 to 60 cents, right? So this table here is a table that I commonly use, and these are the values that I commonly use for options. When I'm selling premium, I'm either selling 1 or 3 or 5. I go all the way. The maximum that I've ever sold, don't try this by the way, it's 30, right? And that requires a lot of buying power. You want a 5-point spread, that's approximately 15,000, give or take. On a 10-point spread, that is about 30,000. So if you were to invest and say get 20 contracts and you only collected 50 cents, right? And you let it expire, or you actually, no, you did not let it expire, right? You sold it, you collected premium and you sold it back to the market and kept 50 cents, then your net profit for that day would be $872 after commissions. Is that useful? Does that help?
That was great. Can you drop that in the chat for us if you share the link? Thanks, Eddie.
I'll share the link somewhere on, I'll post it to, oh, this is a Google Drive spreadsheet. Okay. I will save it on its own because it has other things on it. And then you guys can modify these to your heart's content. But I just wanted to share real quick, because when I'm trading, I want to see these numbers and I'm trying to do the math. All right, the trade is either going, my way or against me. And if I get out for 30 cents, how much am I losing or how much am I gaining? Is it within my trading target? Then if it is, then yeah, we're good. Notice that the lowest premium that I will take home is 10 cents. Anything below 10 cents, you're wasting a lot of money. Especially if you just did one contract, then after commissions and fees, you get to keep only $3.60. Is it worth your time? No, it's not, right? But as the numbers increase, as you go up and higher and higher, then you can get some really good performance on that. The sweet spot, my sweet spot that I have found is that I usually trade around 10 contracts, and I try to go for a minimum, very minimum of 50 cents, right? I try to go for a minimum of 50 cents after selling it, after buying it from the market. I don't usually let my verticals expire, right? Now, there are different schools of thought. I should say that there are different schools of thought. Some people would, sell them far enough away from the action and then just let them expire, which is a great concept. That's okay. That's cool. I used to do that. I've done that many times. But I found that my stress level is much better maintained if once it decays enough, then I can buy it back from the market and keep a certain amount. And that way I don't have to worry about that last minute rush in the market. So that is why I always buy back my contracts, even if they're going to expire worthless, because I'm usually in and out, usually within an hour. And, I like my Starbucks coffee, so hey, nice trading, right?
Hey, Eddie.
Mm-hmm.
In your formula,
Yes.
in the parentheses where you have the A7 times 4, what is the 4? What are you timesing the 4 by?
So remember that you have 1, 2, 3, 4. You've got 4 legs in a contract.
Okay, got it. So this is just for verticals.
Yeah, this is just for verticals, and this assumes that you don't let them go to expiration. You actually buy them back. And since I always buy back my verticals, I have locked in the cost of commissions and everything to buy it back.
Okay.
Yeah.
Okay.
So if you don't buy them back, then you can change that 4 to a 2.
Okay.
Right. So think of in terms of one contract, one vertical has got 2 legs at the very minimum when you enter. You've got a short leg and you've got a long leg. That's 2.
Okay.
Right? And when you buy it back to close, then you're closing your short leg and you're closing your long leg. So that's another 2, and that's why there's 4 legs total. Each leg costs $1.60, and that's why you have that 4 times 160.
And that 160, is that in thinkorswim and TradeStation?
Yes, in TradeStation it's $1.60, and in thinkorswim it is approximately 150, 120. So it's a little less. I think they just lowered my rates.
Okay.
But it used to be 160. So I just took the higher side.
Oh, okay. Perfect.
Just for easy calculation, it is $1.60 per leg for indexes, and for options it is 60 cents.
So that 160, is that per transaction, or that's actually per contract? The 160 is per contract. So if I did 10, like you have the 10 contracts, that 160 is per each leg, 10 per each contract.
Right. That's why you have the A7 there.
Okay.
Right.
Okay.
You see the A7 is actually 10. So it's 10 times 4 times 160.
Okay.
And that is going to give you that's your commissions and fees.
Got it. Okay, that makes sense.
And let them know how much it's going to be for that contract.
So again, Antoinette?
Let them know how much they're going to have in their account.
Yes, this is letting me know that if I sold, for instance, 10 contracts, we make this a little bigger here. If I sold, make it even, make it blue, make this one blue, make it even bold, and that one, make it bold. It's already bold. All right. So in this diagram here, in this table, if I sold 10 contracts, that's my quantity, and I netted 50 cents. So it doesn't matter what I sold it for. I might have sold it for $1.50. I might have sold it for 70 cents or 80 cents. But what I kept after I sold it, which is the difference between the premium I received and the premium at which I bought it back for, I kept 50 cents. If I keep 50 cents after doing my math, then this really is how much will end up in my account, right? Because sometimes you might collect, like in that example that we just sold premium for $1, right? If on Monday it has decayed enough and it is now worth 50 cents and I decide to sell it for 50 cents, well, I'm going to keep $1 minus 50 cents, right? You with me so far? Remember, we sold a contract for $1 and we don't want to wait until expiration. We're just going to buy it back from the market and keep 50 cents. Then if I had sold 10 of them, then my net profit after they've taken out their commissions and fees would be 436. that help, Antoinette?
No, I'm saying let them know how much you gotta have in your account. You're gonna do 10 contracts, how much you gotta have
I see.
to do 10 contracts.
I understand. I understand. All right. So I think yeah, your question is what the margin requirement is. Thank you for that question. Thank you. All right. So in order to be able to sell 10 contracts, we have to use a different formula, right?
Eddie.
And yes.
One caveat. Remember, not margin for options. You have to have the cash.
Cash, all right?
Yeah, you can't use margin for options. Yeah, you got to have the cash in your account.
Yes, you have to have the equity in your account. Yeah, those terms are used interchangeably, by the way. So yes, cash is the correct term to use. How much cash do I actually need in my account in order to do that? So let's go to monitor here and the buying power effect. This is a really good example here, because for that SPX contract, we bought 10 wide, and the buying power effect here required us to have $500, right? That's how much cash needed to be in my account to be able to sell one contract of 500. I mean of SPX. Why is it 500? Because it was a 5-point wide spread, right? How do we know that it's a 5-point wide spread? If we go back to the chain, looking at my strike prices, just looking at this first one, 41.05, 41.10, right? This is 5-point difference. That's called a 5-point wide spread. And to know how much money you need to sell one, then you need 500. Remember that each contract is 100. We've got a 100 multiplier, so we're always multiplying that by 100. You need $500 for one contract. In order to sell 10 contracts, you need $5,000 in your account. All right, $5,000 cash in your account, or the margin power, or the margin ability to buy or to spend 5,000 in during that day. I believe TradeStation gives you 2 times your cash for margin to spend during the day, but overnight they give you 4 times during the day and then 2 times during the day. So it all depends broker to broker what your margin privileges are. But the simple way to understand it is that you need the spread of the width times 100. So on a 10-point wide spread, you would need 1,000 times 100, or 10,000. On a 5-point, you would need 5,000. So for 10 contracts, we've identified that's the buying power. TradeStation treats these a little differently, by the way. TradeStation, from what I have heard, is that if they're going to give you, for instance, 60 cents credit, which is, if you're selling one contract, that's $60, right? And you bought or you sold a 5-point wide spread, they would actually require you to have the width of the spread, which is 500, plus the credit that they give you of $60. So you would actually need $560. Yes, that is very strange. Whereas in other platforms, the premium or the cash required is usually just the width of the spread, 500. All of this should not be confused with maximum loss. What is the maximum loss that you can attain from this? The maximum loss is usually how much, is usually the width of the spread, right, minus the premium received. So in our example, the width of our spread was 5, so that is 500, and we received $1, which is equivalent to $100, and therefore our maximum loss is $400. And why is it 400? Because we get to keep the 100 no matter what. All right, no matter what. Even if we lose, we get to keep that $100. We can spend it. But if at the time of expiration you expire in the money, they're going to require you to have some money that you can give them from anywhere to satisfy, which is going to be the $400. Right? They're going to subtract that from your account.
But Eddie,
Mhm.
sorry. So the credit that you get,
Yes.
you don't get, depending on, so now like how you put in the put credit spread till next week and you wanted to come out of it early, are you still gonna be able to keep that whole credit, or that just depends on where price is at the time, or when you, or how close it is to expiration?
Well, you give it up. If when you close that position, you're giving up the premium or part of the premium that you received. If you let the contract expire worthless, meaning go to its full expiration date, then you get to keep that $100.
Okay.
Right? They don't take it away, or you don't have to give it back. But if you decide to buy that contract back in order to close it, then you're now changing that position from what it was before, and you're basically giving up the contract, meaning that you're renegotiating that contract.
Right.
So if you bought it back at 50 cents, then you get to keep 50 cents and you give up 50 cents.
Okay, got
Right?
it. Okay. All right. Yeah.
And that is why in this example over here, remember that we bought this, we sold it for $1 here, right? That's the number here that we got it for $1, but time passes.
40059.
Okay, let's go ahead and mute that. Okay, so time passes and you decide, you know what, I'm not going to wait until expiration. 14 days is way too far. I'm just going to sell it back, or rather buy it back for 50 cents. Does that help you?
Yes. So when you're doing the credit, whatever you're buying it back at is the portion of the credit that you're keeping. Right. So like if you bought it at $1 and you bought it back at 70 cents, you're keeping 70% of that premium, and you're giving up the 30%.
The other way around, if you sold it for $1, bought it for how much? 30 or 70?
30 cents. That's it.
And bought it back for 30 cents. Then you would get to keep 70 cents, right?
Right.
In which case, you'd be operating on this column over here. So 70 cents would be your net credit, right? Meaning that's how much you receive, you get to keep after all that transaction. And then you go find the column for how many you sold. And if you had sold 10, then your net profit would be $636.
Eddie, I think a better way to tell her is that premium goes with the contract. So when you're selling it, forget the premium. You get what I'm saying? The premium follows the contract. Whoever still has the contract at expiration gets that premium. So who's the last one to sell it? Is that a better way?
Yes. Okay. I get that.
Yeah, you're selling premium. Basically, that's what you're selling. It's a non-tangible commodity. So whoever buys it back from you is actually buying premium from you.
Right. Okay. Got it. Okay. All right. I understand. I don't know. I'm just getting so confused with that. Okay, but I understand though. Thank you.
Yeah, but one step at a time. Understand what the margin or the cash requirement is to trade these many contracts. So, one contract or 10 or 30, right? And also understand how much you get.
Start out with one contract.
Yeah.
Especially when you get ready to go live. Start out with one, baby steps.
Yes.
One.
So, especially for not just for new people, starting out with one.
When you get ready to go live.
Yes. Even I trade one contract. Yeah, even I trade on one contract on a regular basis, especially when my thesis is not very strong, then I will just tread the water lightly and say, you know what, I'm just going to sell one, right? And if it goes against me, then I will get out very quickly. But look and see how what kind of values here that I stand to lose, right? So,
but Eddie, you've been doing this for a while. You did 30 today. You know, you've been doing this for people. I'm just saying for people who's going to actually go live just with one contract.
Yeah, even 3 is a lot. And just to give you an idea, if you sell 3, that is actually $1,500 if you hit max loss. 1,500 minus whatever premium that you got.
Right.
So what I will do actually is I will enhance this spreadsheet a little bit to include max loss and max profit.
Right.
And that way you and also the cash requirement for the trade, so that you know exactly how much you need to get into the trade, how much you could potentially make, how much you could potentially lose, and how much you need to get into the trade.
Thank you for doing that for us, Eddie.
So,
that's gonna be so helpful. I appreciate that.
You're welcome. You're welcome. So yeah, I will do that, and I will post it somewhere so that you guys can enhance it. Now, be aware that, and I'll put a big disclaimer in there, that the math in there will assume that you're buying back that contract. That is what I preach. I always buy back my contract. You may hear that you can let it expire, which is really nice. It's okay. It just depends on your trading plan, and my trading plan says to buy it back. But you can obviously do whatever you like.
Right? Eddie, could you show us an example of buybacks? Because I watched one of your videos, but it would be great if you had a sim trade open that, or you can just walk us through the steps on that.
So the steps are about the same. And remember, here we have a trade that we made a few minutes ago when the market was still open, and it gave us an astronomical amount of money here, right? Market is now closed, but remember we sold this contract and received, actually received, if I do the math on this particular one, $4.60 minus 175, $2.85. Okay. Oh, it says so right there. Look at that, $285. Sim, in its crazy way, gave me $285. So this money was going to be in my fake Sim account, right? But let's assume that the market is still open and I want to buy it back, right? I want to buy it back the Eddie way. So the Eddie way is, pretty much standard. You check off what you want to trade. So you select both legs, right? Not just one leg. I never ever sell the short leg. That don't ever think that you can sell this one because it's losing and keep rising on the other one. Bad idea. Really bad idea. Don't do it. So always check both legs. Yeah. And then click on trade. Make sure it says buy to close, sell to close. And this number represents the number of contracts that you had traded to begin with. And now this is where you have to know how much to put in for the limit price. I usually buy mine back at 20 cents, no matter what. Sometimes less, but 20 cents is my starting bid. And what I'm telling the system is that as this thing devalues or drops in value, when it reaches 20 cents, go ahead and sell it, right? You will almost always find a buyer. In fact, you will always find a buyer. We just bought, we just sold at 20 cents or attempted to sell at 20 cents. right? So there's always going to be people who trade on some of those low values. I don't recommend them. You're just burning up commission cash, right? But assuming that we actually did get $2.85, then we can actually buy it back for 20 cents and keep $2.65. And then send orders. Right now, because market is closed and this instrument has expired, it is now worthless, even though it says here 0.05. You might as well just round that down to 0. And if you look at the option chain here for that 41.90, 41.95, SPXW.X. 41.90.95, you can see the value is 0. I'm looking at the red column here for the bid. Yeah, anytime it is saying it has a minus or negative sign in front of it, or it says 0 or 0.5, it's worthless. Right? It has no value.
And on thinkorswim, is it part of do you do the order first and the vertical and then add it, or do you do it all as one order like you showed us before?
Yeah, either or. Usually what I would do in thinkorswim is I do it in 2 pieces, right? I do it in 2 pieces in thinkorswim. I have not figured out a way to, actually I have, but I don't use it. Why don't I use it? You got me on that one. Let's do it. You can go to the order and say this was your originating order. You can right click and create a duplicate order, right? And since market is already closed, this is not going to go through. But before you confirm and send, you want to change these from a single order to a fast triggers OCO, right? And then once that happens, then you can create your duplicate order, and it is going to give you that order here. Oh, no, wrong way. Opposite order is what I meant. Okay, go ahead and create duplicate order as though it's brand new. Select your OCO here and then create opposite order, right? So this is your opening order. This is your opposite order, right? Meaning that I'm trying to sell this vertical for $1 and I want to put my buyback dollar for 0.2, right? And then that way I can send both of them at the same time, right? I can also add make it fast triggers to OCO, meaning that I can put in my risk management and say that if this price goes above $1 to say $1.10 or $1.50, then please take me out because now I'm losing 50 cents, right? On the other side, you know, this is a good scenario. Prices devalued from 1 to 20 cents, and I get to keep the difference between $1 and the 20 cents, which is 80 cents. Then confirm and send. You guys have seen this dialogue again, right? Enough times today. And the reason I'm being able to do this is because it's aftermarket, and also this expiration date is in the future. It's 14 DTE. So I can put in my buyback orders right in one order and click send.
Thank you. I'll try that in the sim first before I try that.
Yes, do not try these in live.
No, I did my first live SPX today, and I didn't do a buyback. I just watched it for about an hour and then took a profit, a little profit. I did one contract, like Annette said. I mean, Antoinette, thank you, Antoinette, because I was really nervous, but you know, I just did it and it was successful. And I was like, yes.
It's pretty exciting. So yeah, you just have to tread carefully. I always tell people that once you get into sim, try the same trade about 10 times or make $1,000, right? Legitimately.
Yeah, I've been trading sim for about 2 months now. I'm a nervous Nelly.
Yeah, make $1,000 legitimately, which means that don't depend on those crazy numbers that TradeStation gives you. I mean, I have seen TradeStation fill me at $10, $20, and I'm like, wow. I just made it. The very first time I tried sim, it gave me $21,000 on verticals. I was like, yeah, this. I think I'm going to retire early. But after looking at the numbers again and looking at what the live real market was trading at, the realization is that no, this is just play money and it's not real. So in sim, if you're trying a new strategy, try it as many times as possible, duplicate it, become very mechanical about it. You know what to click, you know where to click, when to click it. You know how to get out of it really quick, right? You read the numbers and become familiar with what looks right, what does not look right. For instance, when we entered this trade and I saw $285, I was like, this was supposed to only give me 20 cents. Why is it giving me 200 and something dollars? Right? So that would be your first clue that it's just not right. It doesn't look right. Yeah. So become very, very familiar with the platform. Remember, it's not what the platform is not what makes you a good trader. It's the concept, the knowledge of what you're doing. The platform is just it's just a tool to help you achieve what you want to do. So whether you use thinkorswim or TradeStation or E-Trade or even Robinhood. I traded Robinhood for quite a while, made a bunch of money. It was just limiting. So do I mostly trade using verticals? Yes. Yes. Let's see what else is in the chart. Is this helping you guys, by the way?
Absolutely.
It's awesome.
Awesome. All right.
Could I ask you a quick question?
Yeah, please.
Thank you. Early, like right when you started talking about verticals, you said you were talking about options approval levels. And I prefer thinkorswim because I have a Mac, so I can't really use TradeStation at the same level. I'm not anywhere near wanting to go live with verticals, but I'm only approved for level 2. And I like their approvals are different. But did I infer that like if I just buy my first leg first, then I could then buy the second leg?
Let me clarify that.
Okay.
If you can trade options, you most likely can trade verticals in some fashion.
Okay.
Right. If you can trade options in your account, most likely you can trade some verticals, not all types of verticals. Right. And the reason is if the broker decided to, for some reason, exercise you, or the person that you sold a contract to exercises their right to buy from you or sell, then your account size has to be able to satisfy that requirement. And that is the basis upon which the broker decides, are you good for this or not? And they give you levels. So they decide that, yeah, you can sell positions, you can sell naked without having to have it covered, or you must have it covered. But in general, legging into a position, meaning that you you buy the long leg first and then sell against it, that will put you in a vertical situation, which is fine, which is the intended result. That is 2 day trades, by the way.
Oh, okay.
Right, as opposed to when you sell the vertical all in one operation, that is just one trade. That's one day trade.
Okay.
Okay.
And if I were to do that, could I close it the same way that you just demonstrated?
Yes, you can close both of them. Even if I open this one separately, say I entered this trade, the 41.95 call first, and then later on in the day I sold against it to create a vertical, I can still close both of them at the same time.
Oh, great.
Yes.
Yeah.
Yeah, you can still close. You just have to calculate what should that price be. What's your average price is that represents how much you received premium.
Yep.
Right. And then you can decide how much to buy it back for. Now, remember, you always buy low, sell high, no matter whether you're selling credit spreads or, call credits or put credit spreads. We're always buying low, sell high. Just buy low, sell high.
Eddie, I have a quick question about this order that you just did right here. You said that it expired worthless. So does that mean you didn't make any money on it? You made money, you own the shares? Like what happened with this order right here?
Okay.
Now that the market is closed.
Great question. By expiring worthless, it means that the price of the underlying did not come close or over my short leg. My short leg was 41.95, and we know that today SPX closed at 41.81, which means that I am out of the money. And out of the money vertical means that it expires worthless if you did not buy it back. And so you get to keep 100% of the premium that you received, plus commissions, of course. So in this case, we kept the 285 fake dollars that it gave us. So if I go to my balances, I should show my unrealized profit as $285. This is going to be in my fake SIM account tomorrow morning.
But if we did that in real life, we would actually have earned how
$20.
much today?
$20.
$20.
Yeah, that's
so
how much.
In 20 minutes, made 20 bucks.
Yeah, pretty much. Yeah.
Okay.
Pretty low revenue, but yeah, it's 20 bucks. You can actually, no, yep, 20 bucks. I don't want to give false hope. But in general, if you are selling credit or selling premium on indexes using this method where you sell high during high volatility moments, like in the morning, and then immediately put in your buyback order for like 20 cents or 30 cents, then in general you should see some good healthy returns, usually in about an hour to 2 hours. You're going to see the market fluctuate, like for instance today was like any day, like any day in the market, a stressful day. Right now it is I'm looking at one long red candle. Was it as calm as it looks like? Not really. Right? So I'm always looking at the 1 hour chart, and I'm always looking at the 15-minute. So somewhere here, this is the 9:30. This is where I entered my trade. And for part of the day, it was going against me, right? And then it came down a little bit and I was able to get out. I could have let it expire. Today, I actually traded the 42.10, 42.15 is where I was today. 42.10, 42.15.
That's the one I traded, Eddie.
Yep. 42.10, give or take, somewhere here, right? So you can see pretty far out from where, from the action, right? But I'm not about to find out if this thing is going to go up to 42.10 at 4 o'clock in the afternoon. It's just not my style, right? My style is have a predetermined target, predetermined profit, and once I achieve it, I'm good for the day. Been trading many years, many days. I can repeat this thing next week 3 times, or 5 days, 5 times. So I don't have to make all my money all in one day. And I don't have to be stressed about it all day long. I don't need that stress. So since I know that I can walk away with, $500-600 from within 1 hour, I consider that a pretty good paycheck, pretty good salary, right? How many people get paid $500 an hour, or even $200 an hour, or $300? Not too many, right? So that's my MO.
That's awesome. Thank you for that, Eddie. Do you have a snapshot of what you just explained that you did, like where you got in, where you got out? Or no, that's in your live?
That's in my live. In my live, I got in, I did, let me look at my phone. I'm going to look at my phone here. Because that's so long ago.
But Eddie, don't
Yes.
forget to let them know how much that requires for you to do that trade to make that $500 or $600.
Right.
Right.
I'm looking at my today's trades here. Sorry for the silence. Yeah, 42.10, 42. I did 2 verticals, two separate ones. I did 42.10, 42.15, and I did a 42.20, 42.15. So they were back to back. Buying power requirement is usually, not usually, it's always 500 times the number of contracts that you're selling, right? And I tend to play far enough away from the fire, and I am if this thing has not bought back in 1 hour, right, I'm out. If it has not bought back, if I've not been able to buy it back, I'm usually getting out, regardless. Does not matter what's happening. I usually just get out. There's other things to do, and that comes from experience that it doesn't take that long to mature that trade. If you're in that trade all day long, something is wrong. Market has not decided. In fact, at one point I was going to cut. Right. In fact, at one point I was actually going to cut because the trade was going against me, and I had already decided, you know what, I'm starting to lose money, and I know this thing may expire worthless, but I don't really want to wait to find out. It's not meeting my price targets, so get out. Just take the loss and do it again another day, right? I'm not one to leave it in there to recover in the afternoon. So.
But did you say that you got in right at 9:30?
I got in at 9:48. Mm-hmm.
And can you talk about what you see that gives you the confidence to get in that early?
Yes, you have to do a lot of charting.
Okay.
So here I've got the 6 months, 1 day. We're trading at all-time highs right now. What that translates to me is that I have no data above here to tell me what's going to happen. Zero. I have no idea what's going to happen up above here. That is true. Not just me, that's everybody. Anybody who has data over here, I'd love to have it, right? So what I do is I spend a lot of time doing my charting, right? I look at a lot of indicators to see what's happening. Let's go to an indicator like ES. So ES today, in the morning before 9:30 in the morning, it was showing negative 25, 30 points, give or take. Leonard, what was it today? Was it minus 25 or 30?
It was, Eddie, it's Vicky, it was minus 22, I wrote it down.
Minus 22, all right. Yeah, but it was above a certain number that I look for, right? And that told me that the market was mostly going to be bearish, right? Bearish meaning that it's going to be a downward momentum. That does not mean that it is going to remain bearish all day long. It just means that most of the day or most of the morning, it's going to be bearish. And then later on, it could turn around or not, right? Let's see what it did. Right. Okay, got too much information in there. Let's try that. Okay. Let's go to the 1 hour one more time. So you can see we started, where did we start? We started here going down, right?
Right.
We started here, we're going down. That confirmed our thesis that we were actually going down. So I bought the call, I sold the call credit spread in this candle, during this candle time frame, right? And I sold it at 42.10 and all the way up to 42.20 here. Understanding that this downward momentum would help my premium decay quickly, right? Before it turns around. And my thesis was that since I had a strong indication from the ES, which is the overnight futures, that my premium was decaying, then I could count on being able to buy it back around 20 cents before the market turns around and keep my 50 cents or however much premium that I was keeping.
Eddie.
Yes.
That was yesterday. We talking about today?
Oh yeah, I'm in the wrong spot. Yeah,
okay.
Here, right here.
Put you on the hour.
Yep, right here. This doji guy, right?
Yeah.
Yeah. So this long thingamajig over here. Is that one? Yep, this one over here. So somewhere in here, I was in and out. Right.
Okay, and those prices make a lot more sense too now.
Yes, somewhere in here I was in and out because the momentum was going in the direction that I had projected, and all the indicators were telling me that this is a down market today, at least for the most part, and that if you sell a call credit spread up here, then it will decay in value and you can be able to get out. Yep. So never trade against the momentum. So don't sell a put credit spread because you don't know how far down it is going to go. It is not a RAS, no. Right? It wasn't a RAS because I sold it above the current price over here. But it was dangerously close to the current price. But the reason I felt confident is because other indicators were telling me that today was bearish. And then switch from the 1 hour to the daily, right? And you can see my zones. Now in my paper trading, I don't have all the markings that I usually have, but I usually chart all these zones over here to see where could we potentially end up today. Remember, I only have data for below current price since we are at all-time highs. So as it goes down, I can see, okay, we are reacting to that, 1 hour or the 15-minute, and I constantly switch back and forth to the 1 day 15. When I'm doing verticals, I know I do not trade on the 5-minute. I don't trade on the 5-minute. The only time that I trade on the 5-minute is I'm trying to scalp, and I don't do so much of that anymore now. So, yep, that's why I felt confident about that.
That's really helpful. Thank you for explaining that. I would love to. I feel like you could do a whole call on like what you look at in the pre-market. But I don't. It's like I have so many questions on that. But I also just realized we've been on this call for a really long time. So I just look forward to in the future asking you, like really picking your brain about that.
Yeah, this is a really long call. It's almost 5 o'clock. But yeah, there's plenty of things to look at when you're getting into a vertical spread for SPX, which is, I agree that's a different call because it's very, very deep.
Right.
But let's summarize. Today we talked about calls and puts and went into verticals. Verticals is for those new to options trading. Who still has questions on verticals? Just the general concept of verticals.
My only question, Eddie, would be, so you only enter them if the price is within a seller zone or buyer zone. But SPX is different.
No, it's the same. I still look at the zones, but my conviction comes from mostly reading the chart to see where price is. Remember, when you're doing verticals, when you're selling premium, you are selling the thesis about where price will not go.
Right.
Right. That's the general idea. In fact, it's the only idea. You're selling premium where price will not go. And because of that, your thesis is that you will make money if price does not go there. Otherwise, if you're selling premium on where price will go, then that's a whole different strategy. And yeah, that's different. Yeah. So like debit spreads, you definitely want to be on the opposite side and now buy to get into the trade. But today we're not talking about debit spreads. We're talking about credit spreads. So.
Right. Okay. And just always go with momentum.
Oh, yes, always check the momentum and make sure that it's in your favor. So if market is going down, then you are selling a call credit spread, right? If market is going up, you are selling a put credit spread, right? And you're always selling, And then immediately after selling, you put in your buyback order. If you do it the way I do it, it's usually 20 cents. And you can expect to get out usually within about less than 90 minutes. Yeah. If I'm still in a trade for 2 hours, it starts to get me a little anxious because it's not going right. The one other thing that is super important is get as much premium as you can get without being risky, right? Which means that don't play too close to where the current price is. In my other video, I suggested that you should look at the ATR and be that far, at least that far away. I have also suggested again that you be at least 1% of the opening price. So whatever, because SPX historically has tended to move between 1 and 1.5%. So if you take that and go the opposite direction, you're not necessarily, protecting yourself 100% from breaching the short leg. But if you can get premium that far away, that's where you should be. And then since my buyback order is almost always 20 cents, then I will try and get 20 cents plus however much I want to keep, right? So my spreadsheet again, if I'm targeting $1, then I will try and sell it for 120. If I'm targeting just 50 cents because it's in the middle of the day, then I'll probably try and sell it for 70 cents so that I can buy it back for 20 and keep 50 cents. Does that make sense? And that's why I have this spreadsheet to tell me my estimated take-home compensation is for that trade. So very cool, very cool. We have 4 minutes. Who's got the honor of the last 2 questions? Wow, everybody got it. Everybody got it. All right. So once again, thank you so much for paying attention. Thank you for your time. Thank you for joining. And so happy that you could all join me today in this live. I called it live trading session, even though we traded mostly in the sim, and that's because we want to stress the fact that oh, my ears are getting hot. Can you hear me?
Yes.
Thank you so much, Eddie.
Can you hear me?
Yes, we can hear you.
Yes.
All right, good deal.
Thanks again.
Yep. So that's about it. I will post this recording to YouTube as usual, and share the link in the same place that I posted the Zoom link, and we'll do it from there again. Thank you, everyone. Have a good
Thank you, Eddie.
Thank you, Eddie. It's awesome.
Thank you.
Thank you so much, Eddie.
You're welcome. Good night.